Well, I'm going to the city and I'm gonna do a city show. And I know all my fans wanna learn how to make some dough. I've been cruising up and down for trades each and every night. And with my iPhone exciting, I know we're gonna get it just right. I'll get inside your mind, we'll have a real good time. We're gonna trade today, we gotta trade today. Go askSlim.
Hi, I'm Steve Miller. Call me Slim. And this is the askSlim Market Week New Year's special. It's look back at what happened in the financial markets in the past year, and a look forward to what might happen in the next year. And hopefully lots of great ideas and opportunities for you throughout this show. Well, investors come to the close of 2019 joyfully riding on an updraft, as this nearly 11-year-old bull market, now having gained 387% off of its 666 low in the S&P in 2009. It's not really that earnings did all that well in the last year. In fact, year-over-year earnings are up less than 1% for the S&P 500, so it hasn't been a great year for earnings, though there is a projection for earnings to be up 5% in the coming year. But it was mostly this year about PE expansion, as the S&P 500 PE started the year at about 19.6 times, and now closes the year at a very high 24.2 times. Now, some of that, of course, is looking forward into the next year with an expectation of a better earnings growth, but at the same time, that growth was certainly in the PE expansion Fed-induced, as the Federal Reserve has changed policy mid-year, a lot different than where they expected it to be. And then that stimulus that came in really sent the markets up in a big way. Some analysts actually say this bull market is only 1 year old, and that the decline that happened in Q4 set off the beginning of a new bull market. Well, I guess it's the way that you look at markets, whether you look at cyclical bulls or secular bulls. And I look at it probably different than most other analysts. And I'm going to show you that I actually think that this bull market in a cyclical way is about over 3 years old. And when we get to the last chart of the show, when I show you the long-term projection of the S&P 500, you're going to understand that. And you're going to understand why I'm going to show you that there is risk coming for the stock market in 2020. That certainly would be different than most analysts would believe when you talk about an election year. The biggest news stories for the year, one would guess, would have brought the market to the downside. The trade war, always in the news all year long, had investors really paying very little attention to any bad news about trade. Yeah, we got a few hours of downticks or days of downticks when things looked bad on the trade front. But then anytime there was a whiff of something getting settled, or the president or somebody in his administration putting out some news, and often it was bogus, the market then took off to the upside. It was really mostly about the fact that markets wanted to go up. You could put all the news behind it you want to, but basically when you look at the momentum conditions of the market, money flows of the market, and the patterns that we look at, they were positive all year long, and the markets continued to move to the upside. So while the trade war was always in the news, it was just really background news, and every single time there was a reason for markets to pop, they did. The activist Fed became even more active, as they had 3 rate cuts, and they bring back QE or not QE, whichever you prefer to call it. It does look like QE forever here, as the Fed acts on stresses in the repo market. And their balance sheet, which had dropped pretty sharply, is now moving significantly over $4 trillion again, and that balance sheet will go to a record in this coming year, because this activist Fed and, of course, central banks all around the world have got themselves just backed up against the wall, and they essentially lose if they stop doing what they're doing because the markets break, And they lose if they keep doing what they're doing because we're in a situation of debt saturation. Debt saturation is something I'm going to be bringing up a lot. And if you want some proof about that, then just look at what's happening in the repo market as dealers can't handle all of that debt, that government paper that's coming out. Yes, government debt that will never be repaid. Imagine if you took on debt with the intention of never repaying it. Well, who would ever give you money unless you wanted to pay 20 or 30%? Well, that might be down the road in a few years where we get to see interest rate spikes that are devastating to the economy and the market, but we're not calling for that in the coming year. We're actually looking for interest rates to go up early in the year, but we think that the period of extraordinarily low rates and the great experiment is not over. And again, we're going to bring you charts later in the show that talk about that. This show is going to look a little different than we have in past years, and you'll see that as we move forward. Of course, the third big item for the year that was in the background was the impeachment. Well, nobody really believes that's going to happen, and all of the discussion and votes that went on in the House, well, that barely brought a flinch in the stock market. It's all gamesmanship on both sides, and I think it's sickening. And without me judging President Trump whatsoever in his guilt or innocence, the biggest crime may be the process that we see going on right now, as we have a government so separated with so much polarity that there is never hope or never is a long time, at least in the foreseeable future, for this government to come to any kind of compromises or any sensible legislation. And we've been in this for lots, long period of time, and I don't see that getting any better as we move forward. In fact, in this election year coming up, it could be a lot worse. With all of that, pullbacks were, as I said, pretty minor in 2019, with the biggest pullback being only 7.6%. And the S&P gaining almost 30% on the year. So a unbelievably huge year. This is the second largest increase since that low back in 2009. And again, gaining nearly 400% since that low. We've had 3 drawdowns of any measurable significance in 2019, at 7.6% and 6.9% and 5.5%. This has been the ugliest of ugly years that I can remember as far as opportunities for short-term traders. The investors have loved it, as I say, basking in this updraft, just letting these upward winds blow them up to the sky. And of course, eventually the winds die down and the energies change and the money flows change, and that's what happens. So I think that 2020 is really going to bring back a trader's market that we did not see at all this year. And I'm in contact with traders and fund managers, and the ones that are active, they struggled, and the ones that are passive that just needed to be in positions, well, this was a good year. It was pretty hard to look bad for the fund managers. And if they're not making money, or if investors are not making money who are long-term holders in 2019, well, I don't know when they possibly would. So I think that this period that we've had in here is ending, and that 2020, 2021, 2022 are going to bring much bigger swings, a much different market that we've seen in here. So for us, as the markets change and I change as I get older, and as we get this the askSlim business into a much broader team and much broader type analysis we do, the nature of this show and the nature of the team is changing also, with a huge expansion to our content. We really work hard to bring educational material, analysis, information, and support for traders. So you want to really, raise your odds of success in what I think is going to be a far more volatile market, whether you're a trader or an investor. Well, you could start out by following us on Twitter and becoming a YouTube subscriber. We're in the process of putting together a different format that you'll know about in the next couple months, where we bring more things into YouTube. So you're going to want to be a YouTube subscriber. And do try, if you're not a member now, for new members, write to Matt, M-A-T-T, at askSlim.com for our trials. We have many trials out there. You can get a trial for level 2, level 3, level 4. Just amazing things that we put out there. So that's my little promo for this year-end show. Follow us on all of those venues and do become an askSlim member. The more members we have, the greater our ability to keep bringing more and more content as we develop the depth of our team. So now we're going to switch over a little bit here, and we're going to talk about the next year, and that is a little bit of a review of what I said last year and our view for 2020 in the markets. So let's start out with just a little recap of last year. Again, as I said, it's going to be a little bit different than I did in the last 7 years that I have been doing this year-end show, since I did it for about 4 years, 3 years or 4 years, when I was with my old buddies over at Tasty Trade, and now doing it for askSlim. So we're going to change it up a little different. My stock picks for last year were not great. They weren't horrible. I would rate myself about 45% out of 100. The 12 best stocks that I was looking at, there were 10 up and 2 down. Valero was the best one. And the Japanese yen, the FXY, or the future, was the weakest of those choices. I still think the Japanese yen is going to end up to be one of the strongest currencies as we move forward in the next year or two. For the stocks that I thought were the riskiest, 14 of those were up and 1 was down. Healthcare really looked weak throughout a good portion of the year. So it was actually better than that through a good portion of the year. But then healthcare got stronger as the Democrats started to change their tune about not ending the HMOs, healthcare, not taking over and changing the way they look at what the future is. Maybe it's just all about not wanting to shake up the markets. So healthcare did go down and then rebound. Credit card companies are shockingly strong. And just as we see the shippers like Federal Express and UPS extraordinarily weak, based on the online companies wanting to take some of that money back, I think that's going to come to credit cards too. That did not happen in the last year. I still think that is going to happen, and we're going to see the likes of Visa and MasterCard and all of them really start to give back a lot of their gains over the next coming year. Lulu was by far the best stock, just exploding to the upside in my list of riskiest stocks. Netflix was one of the weakest and down for the year. And the euro currency, that was strong. We expected it to be down, but it was down, but the dollar was actually stronger. So that wasn't a great call there in the euro either, though we did believe it would be down, and it was down. The overall, we would say that we did not do that great, a little not quite average, and we want to be a lot better than that. So as far as the individual markets go, almost every market made higher highs than what our expectations were. The only one that didn't was the gold market, which we thought would be up, and it was strong as we thought, but it didn't quite make our upside targets, though it's coming up later in the year. So that's a bit of a review. It wasn't a great year for us last year as far as looking forward for a whole year. Well, that was then. And now we're going to take a little different approach to how we do this show. As we move into 2020 and the 2020s moving forward. I'm turning 70 years old on January 1st, and I want to continue doing videos and doing the analysis, of course, but they have to take a little different format that we've had in the past. And we're going to have Matt and RV picking up a lot of the analysis, and I'm going to stay with it now. I would be sure for a few years. I don't want you to think I'm going away anywhere right now, but I do need to make this show a little bit different. And of course, a lot of our content is going to be broadened and different as we broaden our team, and a lot of the analysis is picked up by people that I'm training in order to look at markets the way that I do. So we're going to make a few changes in here. I'm not going to do my stock picks as I've done the last 7 years. One of the reasons for that is because the Slimulator Momentum Tracker for investors is coming. It's coming soon. We've done a little beta testing on it. Now we're revamping some things in order to make it really extremely high quality for investors. That's going to be for level 1, 2, 3, 4 premium members. For those of you that are investors and only want that, it's going to be spectacular for you. Really raise your odds of success. So if you're not a member, you're going to want to become a level 1 member, because we're going to be offering that up really soon, and you're going to love it. So I'm going to leave the stock analysis, the individual stock analysis, to what comes out of that program as we look at that. So it would be just extremely high quality, and you're going to love it. But now I'm going to come into my projections for the coming year in the 5 major markets. This again is going to be different. A lot of you that are members have seen my big picture analysis. People write to me and keep asking me to do more and more of it. So I decided to bring that big picture analysis into this show and do the 5 major markets that way, and then you can get a good sense for my reasoning about what I think is going to happen in markets. And I think you'll learn a lot about that, about cycle analysis. If you're new to cyclical analysis, cycle analysis, I'm really, I believe, one of the experts in it. And I wrote a workshop on it with 20 videos that we have in our website that you could see, and you can go look at an informational video on that by looking at Cycle Analysis Workshop. You'll learn just a ton about market cycles, and that's what I'm going to bring you right now as we switch over into the charts. Now, I didn't really want to show you the S&P 500, so that was jumping out before I want to get to that. So you could get a little peek at that. I do want to show you light crude. Now, this is a monthly chart of light crude. And what I have in here, and you'll note that I have this gray area right there, and that I have the notes in here about the year colored in the background, and that gives you an idea about whether I think there's going to be a directional change or a big change. And gray means that I do not expect a big change in the coming year in light crude. And I'm going to tell you now about the rhythms in the market so you understand them. So on the bottom is cycle brackets. And what these are just drawing tools. They help us understand the money flow, the movement in and out of markets. We use support and resistances in order to tell us how it's acting relative to those phases, the rally phases, the peaking phases, the corrective phases, the bottoming phases. We use that information to help us, and then we also use momentum, and this is our momentum indicator that you could see right in here. And you could see momentum in here is just not doing anything, just moving sideways right in there. This is a monthly chart of light crude, and what this says to me for the coming year is that we are entering into this period here. This is the final quarter of time in this cycle. That when you look at the final 25% of the time period in the length in the cycle measured from low to low, you will see that every single one of them coming down into 2015, 2016, this is in 2018, This is in 2018, 18, sorry, this is in 17, and here we are in 19. All of this is a period of downside risk. So for 2019, oil was up 28%. It was a pretty good gain. For 2020, cycle patterns suggest an early peak. In other words, right in here. Maybe it pops out above, slightly above that triangle that we see in there right now. But then mid-year it points to a decline down to support, to this level here, approaching $50. Then a rally again into late year. So you can see that we're trading here, and the patterns suggest a movement down and then a movement up to somewhere probably plus or minus a couple percent. Nothing big, a suggested small change. Momentum is not established, and it's because, well, there's not anything going on of significance as we get into this triangular shape, or pennant as they call it. So we're looking for a decline in here near 50, and then another rally back, as probably what happens is we hear about OPEC cheating, or we hear about supply-demand situation, which is still very big on the supply side, remains so, and the prices begin to chop around and move down. So outside of some little upside potential here early in the year, we see it then moving to the downside. And then a rebound. Small change on the year. We'll look for a range of about 50 to the mid 60s in light crude for the year. All right, so now we're going to move into the dollar, DXY. And you can see this great big inverted head and shoulders in there, and a bunch of colored phasing, which I'm going to explain to you. Note the inverted head and shoulders right here, the breakout, and coming up here and tagging the measurement, and then failing here or stopping at this 78.6%. Notice also the large harmonic families, the big low right over here, the big low right over here, and yes, a big low right over here. What does that mean when you look at it? Well, let's get a little closer look right here, and you will see that our note, which is highlighted in red, suggests that there will be weakness. And this period that we're talking about in 2020, where we see multiple cycle peaks and a decline into 2021, mid-2021. Momentum is failing in here right now, but still not giving you anything of significance. So with a 5.6% gain on the year in 2019, we are now looking for a decline all the way into 2021. That are these nested bottoms right in here. So what does nesting bottoms mean? Let's take a little deeper look at this right here. And you could see that there were three nested bottoms coming right in here, and that pushed it down very significantly. There were three nested bottoms coming right in here, and the decline was not as significant. It fell from 84.70 down to about 78. That's still a decline of over 6 points, or about 8% in the dollar, and we could see here we are into this period of nesting, 3 cycles coming down. That's why we see multiple cycles peaking in this year and a sizable decline into 2021. If this analysis is correct, this is pointing to a period of the precious metals having a pretty good time of it as they move inversely to the dollar most of the time. The correlation is inverse. The dollar to the metals, or to gold and silver. So that points to a period, and we're looking for a weaker dollar, and we're going to call for a decline in the dollar in this coming year and into mid-2021, which we think could be significant. You see it pointing down here to that decline, that low right over there. That's at about 88.20. We don't know if it'll make it to 88.20 this year. It probably makes it to next year, and let me tell you, the risk is it will fall much sharper than that. The decline in here of the dollar may very well be a signal of a potential of very low interest rates, because money would be moving out of the dollar based on policy changes. And we're going to talk about that as we move forward and we look at the bond market in just a moment. But we're going to now move over into the gold market. That's / a GC. Of course, it's GLD in the ETF. And now we're going to look again at these cycle harmonic rhythms in here. And the reason I have this on the bottom here is because it's hardly a place that I could find a space. 2019, gold's up about 17.8%. We expected that. Gold fell a little bit short of our upward projection. We thought it would make it to 1600. It didn't quite make it, but you could see. But we did pretty well in gold on that call. The 2020 gold pattern suggests a rise near 1600 again, then a correction into Q3, followed by another surge into 2021. So there you are, that inverse correlation in the dollar. We're looking for a 10 to 15% gain for 2020 and up strongly potentially into the following year. Momentum is strong on the upside, as we see right over here. And what we see also is that silver target for the year is at around $22. So I wanted to put that in there also. Let's blow this out a little bit more, because one of the things I showed when I did my last big picture analysis was this triangular shape right over here. Now, cyclically, it comes at almost the same spot that this does right over here. And that then brought a big advance. You can see right there after that, and we're getting a breakout right over there going on. So this could be the beginning of this move that we believe is up to about 1600 or a little bit better than that. And then this decline right over here suggests that it's going to come down into about the summer, or maybe somewhere July, August, after a rally, and give some area of decline. But we think that would be a buying opportunity, and then this rally going up into 2021. So it's kind of a bigger picture we're showing you, and our expectation is for this rise up to 1600 or better, then the correction into, we'll say, potentially into the beginning of Q3 right over there. Overall, we expect that it will be another year where gold gains, and again, we'll give it 10 to 15% on the upside for the year. So now let's talk about the Treasury market, because when we talk about the dollar potentially going down for some extended period of time, then we're actually going to want to say that that's not good. What it reflects is that interest rates probably could be going down again. Now, look at this remarkable information in here as we look at the, let me just get a little closer look for you to see right here. I want to get this laid out for you well. So what we're looking for is, remember, this is gray. We're looking for kind of a neutral market for the bond market and interest rates. Now, what we're looking for is a decline first in the bond market. And that takes you into somewhere between Feb and April for a low for the bond market, or the high in yields for the year. That down to this level right over here equals about 2.1% yield. That's reasonable. It could go to as high as 2.4 if this gets a bigger dip to the next support. But the bond market is in a decline. Now, you see that 11 up there? That was an 11-month peak. So if that's an 11-month peak, we are 14 months off of this low. You can see that very clearly. From this 19-month low, it rallied 11 and fell 3 so far, so that's 14 months. I want you to note the cyclical action in here. 16 months, 18, 15, 18, 19, 19. All of those, a magnificent rhythm in there, and now we're only 14. That says that this decline is likely to be, if it's average, between 2 and 4 months on the downside. Hence February to April as the projected low in the bond market for the year, with yields 2.1 to 2.4%. Then we look like we're going to have a big upside move. This translation will be very positive. In other words, where this bottom comes will be much higher than this. That says that this peak, there's better than a 75% probability that this peak in bonds will be taken out. Or the low right over here, which happened to make 1.4%, 1.44 in yields, will likely be taken out. We believe that there's a potential crisis of sub 1% yields coming in 10-year in this rally, which takes you 2020, 2021. That, of course, would potentially bring a upside move in the gold market, a downside move in the dollar market. But also it means that if there's a crisis, the stock market is going to get hit, and hit in some kind of a big way. And if that happens and we get into our next deflationary period, then the gold rally won't be able to hold up that well, and gold will get sold very hard also in there, because when deflation hits, then investors, public, they need money, they need cash, so they sell everything. And that's why I believe that gold's best time of it will probably be in 2020, maybe not be able to get into 2021, and a very strong possibility for record low yields here in the U.S. coming into late 2020, 2021. The question is, what will the crisis be? What will bring that you can get that kind of a low? And you can see here, note the positive correlation, the positive configuration here where this closed well above where it began. It brought that huge rally right over there. Here is another one right in here. 18 months brought the huge rally after that. So positive new high, positive new high, positive and then new high or new low in yields coming. That speaks to something out there that is not very pleasant out there. For 2019, the yields actually fell for the 10-year from 260 to 1.9, where we are now. The 2020 pattern suggests a drop in treasuries into Q2, and then a sharp rise beginning for record low rates in 2020, 2021. Momentum right now positive and stalling. It's probably going to be giving you a downward tick in momentum for a brief period of time, and then be moving sharply to the upside. We would say that sometime around April, May would be the time that we would expect that the bond market would beginning to move up in some significant period of time. So that is the big picture and the bigger analysis in the bond market. You could see the beautiful rhythms there in bonds. They are spectacular. And that shows you the money flow and how interest rates do move up and down in an extraordinarily consistent way. And that consistency, we believe, will continue, and that major cycle peak that you see right there will be taken out in the 10 years, and that means record low rates coming in sometime late 20 or 2021 for the U.S. economy. And what does that speak to? Well, probably crisis. Next thing we're going to look at, or the last thing, is the stock market. Here is the S&P 500 going way back, and there are lots of things that we're going to talk about here as we look at this. This has a little more involved analysis on it that you could see. What we're looking at in 2019 is the S&P 500 now up about 29%. We still have 2 more days to go when I'm recording this. The Dow is up about 22%. The healthcare stocks way down a little bit. Boeing, of course, way down a little bit. The NASDAQ clearly the best, 36% gain, and the Russell up about 22%. That is coming on and strengthening late in the year, but still, as you could see, the laggard in there. And somewhere here, as we get into final stages of the bull market, I think you're going to see the Russell overperform. And then again, this isn't like anything we've seen in the past, so that may not be the case. 2020 cycle patterns suggest a bull peak in 2020 with a major bear market into 2022. The minor monthly cycles, and I'm going to show this to you, point to a corrective period into the second or third quarter. and then a stronger fourth quarter. So that, here's your election year. I think it's going to be weak into the middle of the year and then gain in towards the election time. And that break and that rally, I'll give you some detail on, but the late high could test the highs that we're making now, 3250 to 3300 in the S&P 500, before the bear really sinks in. And you can take a peek there on the right. You could see my projections there. And we're looking for a small loss for the year. Nothing really all that significant, but we're going to call for a down year. Momentum is strongly positive, and it has been that way for this entire year. So you can see that strength. Now I'm gonna explain some things in here for you to see, and what I want you to note as I bring this up and look at a little bit more data in here, is you could see the 2022 peak right over here, 2002 peak, and then the bear market. You'll notice in here that there are harmonic families. In other words, this is like music. This is your dominant pattern right in here, and that dominant is 80 months long. Your intermediate pattern right over here is 40 months long, and your minor cycle pattern in here is about 20 months long. So that 40-month long one is, when you look at that, that's about 3.3 years. So it's about 6.7 years on the bigger cycle. And those are different than we had looking back decades ago, where you had an average of about 53 months that was going on. And now you have this new rhythm that's going on in this period of government invasiveness, and Fed central bank invasiveness has changed things a bit. But you still could see the beautiful rhythms in here. Now, here's your 2002 peak, and note 3 cycles bottoming in here. Each of these put downside momentum right there, downside momentum, and you had the big break. The same thing right in here, and you'll notice that it's the 4th minor cycle right there that tends to bring the biggest declines. And so the reason there are 3 stars there is because it shows you 3 cycles bottoming right there. There was 1 little cycle bottoming here and 2 here. When there's 1 little cycle bottoming on the minor one, you don't get much decline, and when there's 2 of them, you get a little more decline, and when there's 3 of them, you get a bigger decline. So here you could see the rally here into 2016 and the mini bear market right there. That was down about 17%. And comes down right over here, and then you had 3 cycles bottoming right here. So that's the lows that we made here in 2016. So while some analysts, as I said in the beginning of the show, talk about this as being a bear market low, and I do believe with the 20% decline, it was a mini bear. When you look at these cycles, it comes right in the middle here. So there's 2 cycles that were coming down here. It's not the 3 cycles or the really big decline that's due when they all come down right over here. And that is yet to come. And that comes out to bottom in 2022. So we have a lot of bear market potentially ahead of us. You'll notice this bear market over here where it peaked and then broke down, that was a pretty average decline of some 18 months on the downside, depending where you measure it. This is a pretty normal decline in here of, again, over a year on the downside. So if you're going to get over a year on the downside, that means you're going to get a lot of choppy market or topping market as it extends out in here. So now let's again talk about what we're thinking about for the year. Now, if we're in this period of these cycles, let me just blow this out again for a second for you to see, of these cycles coming down right in here. Now, this is the highlighted area, this red area. That's this 3rd minor cycle declining right in there. So you see where the 3rd one declined right in here, you got a decline of about 6%. Not that much, right? You got this one right over here, you got a decline of about 11%. So what we're projecting is that there's a decline coming here into the corrective period of Q2, maybe Q3, which is likely to get you this dip of 8 to 12% on the downside. So that projects to 29.90 in the S&P down to about 28.60 right over there. So the support right over here is 26.93. That would be a lot deeper, right? So you see we don't have it projected that low. But still, we expect that there will be some 8 to 12% decline as we look at this for the coming year, and then another rally back. So you can see that fib target zone that we had there, momentum moving up strongly and getting to the bottom of this fib target zone right over here, which lines up at about 3250. The weekly fib target zone goes up to about 3,300. So we think this is going to be rolling over and give you that correction into this Q2 or Q3 period over here. Depending if it shortens up and it wants to, move up into election time, it could bottom in June, July. It could bottom August, September, depending on what the environment is. And again, we're only looking for about 8 to 12% pullback into that mid-year period. And then comes the rebound into the end of the year. Hence, we don't think it's going to be a very big change for the year, though slightly down, not being able to recover this decline in here, which, again, 8 to 12%. But if it was 20%, it wouldn't shock me if that was the case. And then rebounding, and then sometime here in late 2020 or the beginning of 2021, giving it up, and then the full-fledged bear market coming right in here. Because we think interest rates are going to go to a crisis low in 2021, we think that this peak is likely to occur in 2020 and that we have this extended out too far, but it's pretty hard to extend out in months when you look at this. So again, what we're looking for this year is an early peak in the year, a pullback sometime into mid-year, and then another rally and ending down slightly on the year. That is a look at the stock market. We think it's going to be a tougher year for investors, but again, no washout for them. And those that persevere and wait for buying opportunities, it's probably going to be there. Those that are looking for opportunities for trading, I really believe this is going to be a much, much better year coming up for the trading world out there that have had such a tough time for it in the coming year. Implied volatilities, we would guess, will average significantly higher than they have in the last year, maybe similar to what we saw the previous year where there were some pretty good jumps. I wouldn't be surprised to see implied volatility hit 40 by sometime in the summer. And overall being skewed more to the upside for implied volatilities. Better year for traders, a harder year for investors, but probably a year with a lot of opportunities for all. I want to thank you for all of the support that we've had from you all year long, all of our viewers, all of our members. Really, want you to become a member. If at very least you're an investor and want to support us, become an askSlim Level 1 member. You're going to love the information coming out of the Momentum Tracker when that's brought to you in the next couple of months. And you're also going to just love all the support that we give to everybody out there in really all styles of trading and investing. You can look at my coaching programs. You can look at our workshops, the absolutely incredible work that we're getting out of Matt and Arvi and the rest of our team that is working on bringing all the content. Happy New Year to you all. I'm wishing you and yours prosperity and health. And I want you to be so unbelievably careful because it is so crazy out there. And I'm always wishing you great trading.
Well, I'm going to the city and I'm gonna do a steady show. And I know all my fans wanna learn how to make some dough. I've been